6 months ago, this was the hottest tech IPO of the year. Today, the stock is down 70%, while the founder and early investors remain wealthy. Was this simply a bad investment, or did the system work exactly as designed? Why did insiders reduce their risk while public investors absorbed the collapse? Behind the headline valuation sits a three-part engine: scarcity, consensus, and constant markups. By the end, you will understand how paper value is created, protected, and finally transferred to the public.
Hot startup rounds rarely feel open. You contact the founder and reach a junior associate instead. They say the round is heavily oversubscribed. A small allocation may still be possible, but only if you move quickly. The pressure feels like evidence that the opportunity must be real. But a startup does not need 20 funds fighting for the same position. It needs one lead investor and perhaps a few syndicate partners. Much of the remaining competition is scarcity theater. That theater is valuable because it changes how investors behave. A carefully leaked signal can compress a decision window from weeks to days. A casual conference comment can spread through the limited partner community. Competing firms begin to fear that they may be locked out. Missing the next category-defining company suddenly feels unbearable. Fear of missing out starts replacing patient analysis. When the round closes, the private signal becomes a public event. Tech publications repeat the funding announcement. Databases record the new valuation as an official-looking fact. Yet that number was negotiated by only a handful of people. It becomes the anchor for every future discussion about the company. Each later round begins from that manufactured reference point. By the time public investors see a stock price, years of signals have shaped it. Those signals were not created through normal public market price discovery. You are not necessarily buying near the beginning. You may be providing the exit. Scarcity gets your attention. Consensus makes continued questioning feel unnecessary. 3 or 4 elite venture funds often cycle through the same deals. Fund A leads one round. Fund B leads the next. Fund C arrives during the growth stage. From the outside, this appears to be independent validation. Each firm looks sophisticated. Each firm seems to have reached the same conclusion alone. The reality is far less independent. Once respected investors have already approved a deal, deeper scrutiny carries a social cost. Finding a problem means questioning more than the company. It also means questioning the judgment of powerful peers. Careers in venture capital often reward deploying money, not avoiding every loss. Missing a deal that becomes a giant winner can damage a career. Joining a deal that later fails may become only a write-off. For the individual partner, entering the round can feel safer than resisting it. Even a company with negative unit economics can raise repeated rounds. Every new round appears to validate the investors who entered earlier. Those earlier investors point to the new money as evidence they were correct. The consensus cascade survives as long as another check arrives. Public investors often assume serious due diligence happened before the IPO. In many cases, what happened was mutual reassurance inside a small network. Everyone needed the same story to remain intact long enough to exit. Scarcity creates the desire. Consensus removes the doubt. The markup machine builds the paper fortune. A venture valuation is not the same as a public stock price. There is no open market. There is no continuous bid and ask from millions of participants. There is usually a negotiation among a small group in a private room. Their chosen number becomes the official price of every share. Suppose a late-stage fund invests $50 million at a $2 billion valuation. That transaction instantly reprices all earlier shares. A seed investor who contributed $2 million may now show a stake worth $40 million. The increase exists on paper. It appears in quarterly reports to limited partners. It helps justify management fees. It can also support the launch of another fund. Yet the lead investor may hold protections hidden behind the headline valuation. Preferred shares may be paid before other shareholders. Liquidation preferences can guarantee a minimum recovery. Ratchets may adjust ownership if the next round is priced lower. The headline price can therefore hide very different levels of risk. Later, mutual funds and sovereign wealth funds begin chasing private growth exposure. They may lack the same side agreements and access to company records. The inflated marks from earlier rounds become their negotiating baseline. The layer cake rises from $1 billion to $2 billion, then $4 billion. Each new round is presented as proof that the previous round was correct. Banks may price the IPO only 10 or 15% above the final private round. Retail money then floods into the newly public stock. Within 18 months, it may trade below much older private prices because public buyers demand profits or a credible path to them. The uncomfortable truth is that the valuation became the product, while the company became its container. Now step back and examine the whole machine. Scarcity manufactures demand where little may naturally exist. Consensus suspends the skepticism that could expose weak fundamentals. Markups then create the paper returns that justify the cycle. Each component strengthens the next. No single person needs to organize a conspiracy. Every participant already has a rational reason to keep the system moving. Founders want higher valuations to reduce dilution and satisfy ambition. Venture partners want markups for reporting and career advancement. Limited partners want to believe their capital is growing. Journalists want access to the next major funding story. The system emerges without requiring one central villain. Short-term incentives are enough to keep it alive. The decisive moment often arrives at the IPO. Public markets demand actual price discovery. New buyers do not need the private market's shared narrative. When the markup fiction meets open supply and demand, the price adjusts. The decline may happen gradually or all at once. The structural asymmetry is what should concern public investors most. Insiders can sell into the IPO surge and during the months that follow. After lockups expire, the stock may continue drifting lower. Retail buyers and index funds absorb much of that decline. The architects of the valuation may already be moving to the next deal. Your first filter is the company's complete capitalization table history. If the final private rounds jumped without matching revenue progress, walk away. Your second filter is to ask who is missing when every famous fund appears present. Read every future tech IPO prospectus with one question: who already won? The quiet truth is that the real product was the valuation. Follow for more breakdowns of the financial machinery behind the headlines.